In this video, I'm going to talk about accounting for law firms. I'm going to give you some general concepts, but just keep in mind that every law firm will be a little different. One of the most important things when doing accounting for a law firm is to understand the trust bank accounts. These are bank accounts to hold client funds, and this could be client funds in the form of retainers that they collected from clients. It could be settlement funds for some kind of case settlement, or it could be funds for a property purchase or something along those lines. There's a lot of different types of law firms out there, but the point is these are funds that are held on behalf of someone else. These funds are kept separate from operating funds. So typically they'll have an operating bank account and then a separate trust bank account. And a higher standard of care should be used when handling this money and doing the accounting for this money, because this is considered holding money for someone else. So the accounting needs to be 100% accurate. And I say trust bank accounts, but in practice, almost all the time, I'm actually dealing with something called an IOLTA account. IOLTA stands for Interest on Lawyers' Trust Accounts. And this is a bank account that is an interest-bearing bank account, but the interest isn't kept by the law firm. It's instead remitted to state bar associations. The funds are used for charitable purposes, and I'm going to put a link in the description with information from the American Bar Association with more information and details about these types of accounts. So when you're doing the accounting for this, you'll see a deposit of interest, and then a lot of times a deduction or an expense where the interest is taken right back out of the bank account, a lot of times on the same day. So you would just be accounting for the interest in and out, and it's typically a wash or zero net effect. And a lot of times there's special rules related to handling the trust funds, such as the length of time between the deposit and the disbursement, just to make sure the funds clear. And reconciliations, different states might have different reconciliation forms or documentation. So it would be a good idea to look up that state bar association wherever the law firm is that you're working in and trying to get more information and more specifics. Now I want to talk a little more about some of the funds that are held in these trust bank accounts and the accounting that would be related to it. First of all, a retainer is a fee paid by a client in advance of legal services. Some law firms will collect a retainer at the beginning of the legal engagement. They'll collect the money and typically put it in a trust bank account. And then that retainer would be used to pay for legal services as the legal services are provided or performed. So the money's going to sit in trust for the time being in the beginning, and then it will be moved later. And just keep in mind that I'm giving you general concepts, so this is not going to be exactly how it is in every single law firm. Now, as far as the accounting is concerned, these retainers that are held in the trust bank accounts would be posted to a current liability account. I've seen a lot of different names for this account, but probably the most common ones are something like trust liabilities or client retainers. When a deposit is made into trust, let's say they collect a $5,000 retainer from a client, that would be debited to the checking account, to add to the checking account, and credited to trust liabilities, which would be adding to a liability account. Now, these are treated as liabilities because at this point, they've just collected the money. They haven't earned anything yet. So you're basically treating it as an unearned revenue at this point. Now, depending on what software you're using to do the accounting, the actual entry in the system is going to vary by law firm. If you're using a law-based software, you might simply post a deposit to trust on that matter or on that client in the software. Or if you're using something like QuickBooks, you're simply posting a deposit and your category would be trust liabilities. And then as legal services are provided, an invoice is typically created and sent to the customer. And then the funds to pay the customer invoice would be moved from the trust bank account to the operating bank account. And this could be done via check or bank transfer. It just depends on the law firm and how they handle it. But the point is the money would be taken from that retainer and used to pay the customer invoice for legal services. And this would be the entry when the money is removed from the trust account. Now, I'm just looking at the trust account side at this point. I'll look at the operating account side in a few minutes. Basically, when you're removing the money from the trust account, you are subtracting from trust liabilities with a debit and subtracting from trust checking with a credit. And that's it. It's just the opposite entry as the deposit. And if you wanted to look at it from a T account standpoint, let's use the example of the $5,000 deposit for the retainer. That would be a debit to checking, credit to trust liabilities. And then when money is removed to send to the operating account to pay the customer invoice for legal services, that would be a credit to this account. And if you were to get the balance of these two accounts right now, it would show $2,000 as the balance. The client paid a $5,000 retainer. $3,000 of it was used up, so that leaves them $2,000 remaining as a retainer. And then on the next invoice, let's say the next invoice was $2,000, you would do the same entry, and that would zero out that account and that customer's retainer balance. Obviously, you would probably have multiple client retainers in here, but this was just to demonstrate the in and out of the accounts. Now let's look at the operating account side. This is going to work in a similar or the same way as any other company that you do accounting for. On the operating account side, invoices are typically created as the legal services are performed. Just like any other company, the invoices are created, sent to the customer, and the customer is expected to make sure that invoice is paid. Now, in this case, the customer would have a retainer balance. So the invoice that is created is more for information purposes for them, so they know what the money was being used for. They've already paid the retainer at that point, but they probably want to know what services are being performed, how much those services have cost so far, and how much they still have as a retainer. But the invoice is still created and sent to them as normal. And then the funds from the retainer and trust would be moved over to operating to pay the invoice or apply to the invoice. So on the operating side, it would be a debit to the checking account and a credit to the income account. And of course, it might not look like this in practice. In the software, you might be creating a deposit, you might be creating a payment and a deposit. So it would depend on your software, but this would be the underlying debit and credit. And then for those of you who want to be technically, when you create the invoice, it would be a debit to accounts receivable, credit to income. And then when the payment is posted, deposited to checking, it would be a debit to checking, credit to accounts receivable. And I just also want to mention that a lot of times these invoices are created periodically, such as once a month or twice a month, and then several payments will be moved over from trust to operating at once. Now I want to talk about a different kind of case. Instead of paying a retainer, sometimes the client instead pays when the case settles. And the payment to the law firm may consist of a percentage of the settlement or some predetermined amount of money. In this case, the settlement amount, the total amount, would be deposited into trust, and then the funds would be dispersed from that account. So let's say the settlement was $100,000. It would be put into the trust account and then the law firm would disperse it. Some of it might go to the client, some of it might go to medical providers. For example, if it was a personal injury case, some of it would go to the law firm to pay the legal fees and any costs that they might have incurred. And I'll cover the costs in just a few minutes. But the point is this would be a little different in that there wouldn't be the monthly invoices or the bi-monthly invoices for legal services. It would be more of they would deposit a large amount of money or a lump sum and then disperse it out. And the amount that covered the legal fees of the law firm would be transferred over to operating. But the entries into trust and out of trust would be the same. As money is put into trust, in this example, $20,000 was put into trust as a potential settlement amount. Some of those funds might be used to pay the client for their portion of the settlement. Let's say they were paid $10,000 of that. And then some of the funds would be used to pay any costs related to the case. So if it was a personal injury case, it could be to pay the medical providers or something along those lines. And notice the deposit is simply a debit to trust checking, credit to trust liabilities, and any money pulled out of that would be the opposite. You're debiting trust liabilities, you're crediting trust checking. So you're just subtracting back out of those exact same accounts. And then there would likely also be funds to pay the law firm for their legal fees. And it would be the same entry. You're subtracting, debiting trust liabilities, subtracting from checking by crediting trust checking. And the net effect of those accounts once all the money is paid out should be zero. And then, of course, on the operating side, they would show the $4,000 as legal fee income. Now I want to talk about reimbursable costs. I find that in law firms, there's a lot of times a very large amount of client costs. So I want to talk about this specifically. Reimbursable costs are costs paid on behalf of a client. And these are costs that the law firm expects to be reimbursed for. And I see a lot of variations on account names, so I put a few of them here just so you'd have an idea. And this is going to be the tricky part because some law firms treat their costs as current assets. So it's almost like it's a receivable in a way. And then some law firms treat them as expense accounts. I would say the majority of the law firms that I've worked for treat the costs as a current asset. But I do occasionally see them treating it as an expense. And these costs are typically paid from the operating account. And then the law firm will put it as either part of their invoice to be paid from the retainer, or they receive a portion from the settlement to cover the costs. So I'm going to talk about the accounting for this, but I do want to mention, or I do want to talk a little bit about how to know whether to treat these as an asset or an expense, because there can be a lot of confusion on this. As far as what is better or worse, I did a little bit of research on this, and I found an IRS publication that basically pointed more towards it being treated as a current asset. So I'm going to put that in the description. But when I looked up just general reimbursable expenses and how to treat them, I found information that they should be treated as an expense. So I would say for this, refer to the tax preparer if you're not sure. And then before I get into the actual accounting entries, I want to talk about hard costs versus soft costs. Hard costs are costs that can directly be traced to the matter or the case. And these are costs that the law firm will likely want to get reimbursed for. Things like court fees, filing fees, mediators, transcripts, depositions, postage and shipping, witness fees, expert witness fees, delivery services or messengers, any specific travel expenses such as mileage, taxis, things like that, medical records costs, medical expenses. And these are costs that they would track for that case, and then they would want to bill for that cost and get reimbursed. But then soft costs, some law firms do bill for these. I don't see this nearly as much though. These are just overhead costs of the business that aren't necessarily easy to trace to a specific matter or case, but the law firm may add some of these costs to the bills. I'm going to focus on the hard cost entries, but just know that you may see soft costs as well. First, I'm going to talk about how to treat reimbursable costs if it's treated as a current asset account. When this is treated as a current asset account, it's almost like it's treating it as a receivable in a way. This separates the cost from the profit and loss. Basically, you debit the account when the cost is paid to the vendor, and then you credit the account when the cost is reimbursed by the client. So it's simply a debit and a credit, and it gets zeroed out as soon as they get reimbursed. So when they pay for the cost, let's say they pay a $500 filing fee, they would post it to client cost advance. This would be the category. And then when they get reimbursed, it would be a credit to this account. Once they get reimbursed, this account would zero out. The debit and the credit will zero each other out. So let's look at some journal entries. When the law firm pays a cost on behalf of a client, that would be a debit to client cost advanced and a credit to, usually these are paid out of the operating account. Not always, but most of the time. And it would be a credit to the operating checking account. And then when they receive payment from the client, let's use that $3,000 example from earlier. The client is invoiced for the $3,000, and let's say $2,800 of that was legal fees, $200 is this cost reimbursement. That would be a debit to the operating checking account, a credit to legal fee income for $2,800, and a credit to the client cost account for $200. The debit of client cost advance up here of $200 would be offset with this credit once the client pays. So the debit and credit would zero each other out in that account, and it would be a zero net effect. And then let's look at what it would look like if it was treated as an expense account. If using an expense account, the cost would be treated as an expense, and the cost reimbursement would be posted to income. The expense account would be debited when the cost is paid to the vendor, just like any other expense. And when they get reimbursed by the client, it would show in income. But the net effect is going to be zero because the expense of what they pay should be the same as the income that they receive for that cost, unless they mark it up. But the net effect would be income. Let's say it's $200. It would be income of $200 minus the expense of $200. Well, that's a zero effect anyway. So let's look at the entries for that. When they pay the cost, it would be a debit to that expense account, credit to checking. And when they get reimbursed by the client, let's again use that $3,000 example. It would be a debit to checking for $3,000. The $2,800 for legal services would go in the legal fee income account, and then the $200 would be posted to reimbursable expense income. And this just shows that the income would be $200 as the credit, the expenses would be a debit of $200, and the net effect would be zero. And then the last thing that I want to talk about is the trust account reconciliation. This will be an additional reconciliation beyond the regular reconciliation. I do have a couple videos about this with examples, but I want to give you an overview of the general concept in this video. First of all, when reconciling a bank account, you would be comparing the bank statement to the books. That's a regular reconciliation for any bank account. So you would do that for the trust bank account. But then for a trust bank account, you would also do something called a three-way reconciliation. You're comparing the bank statement to the accounting records or books, but then you would also compare it to the ledger of client matter balances. And this should be done periodically, preferably once a month. The easiest way for me to show you this is to show you an example with some numbers. So let's say this company has a reconciliation in their bank statement and accounting records show $40,000 as the balance at the end of the month. This would be their regular bank reconciliation. But then they would also want to take that one step further and figure out what clients or matters make up that $40,000. So let's say in this example, matter A had a balance of $10,000, B was $5,000, C was $8,000, and so on. You would want to look at each matter or each client or each case, figure out what their trust balance is supposed to be at the end of that month, and then make sure the total of these individual balances add up to the $40,000. And if you do the math, they do add up. Now, of course, in a real situation, it's going to be a little more complicated. You'll probably have a lot more cases or matters, and there will be outstanding checks and deposits in transit, sometimes also that would have to be factored in. I do have an Excel spreadsheet available on my website with an example of this, and the formula is already set up in there. So you're more than welcome to download that, try it out, experiment with it, and see how you do. I hope this video was helpful. If you have any questions, feel free to comment below, and thank you for watching.